Capital Gains in Canada and the U.S. Tax 101. I am Emily Yu, and I'm joined today by Cassie Lee. Cassie is a Senior Manager at Andersen. We will be addressing questions at the end of the webinar. There's a section at the bottom of your Zoom screen for you to submit yours. We are fortunate to have two managers from our offices, Christian and Janice, facilitating the questions for this webinar. We are hoping to provide attendees with the CPE hours in future. As a part of the CPE requirement, there will be polling questions throughout the webinar. So when you see a polling question, please submit your answer to each one of them to confirm your attendance. We will have a short survey after the webinar. We would really appreciate your taking the time to complete it, to provide feedback for us to improve our webinars going forward. And also, if you have suggestions for future webinars, please do share with us. So the focus of today's webinar is on capital gains, mostly for individual taxpayers. We want to highlight differences between Canada and the U.S.'s tax laws and implications for people in a cross-border setting. We want to discuss real property and some new rules in Canada and the U.S. related to gains and real properties. Some of you may have attended our webinar last July that included broader discussion of capital gains. And if you haven't, please feel free to watch it. We pay so much attention to capital gains, and that is because gains are often taxed more favorably in Canada and the U.S. compared to other income, and certain gains are just not taxed at all. We will get started then. Cassie will help us start by comparing how each country tax capital gains.
Thank you so much, Emily. So we'll just do a quick comparison first, just to get an overview of the differences between the two countries. So in Canada, capital gains has no required holding period, and the tax rate, the top marginal rate would be at around 27%. Whereas in the U.S., as you can see, there is a holding period requirement. So there's different tax rates for each period. If it's been held for less than 1 year, less than or equal to 1 year, it's considered short-term capital gains. And this will be taxed at the ordinary rate of 37%. If it's been held for more than 1 year, it will be considered long-term capital gains. And this is where there's preferential rates here of up to 20%. So it could be lower than this. The capital loss carryback is a Canadian concept, and it can be carried back for 3 years, whereas in the U.S. there's no carryback allowed. However, both countries have unlimited carry forwards to offset capital gains. There's also installment sale rules. In Canada, there's a maximum 5-year deferral, whereas in U.S. there is no time limit. So if we can go to the next slide, I will go over the tax rates here to see the differences between capital gains versus ordinary income. So as you can see on the screen here on this chart, for Canada, in general, capital gains is taxed at 50% of the compared to ordinary income. Whereas on the U.S., the long-term capital gains, as we mentioned earlier, is taxed at up to 20%. So all of these rates are on the top marginal rates just for comparison purposes. So for capital gains on the U.S. federal side, it could be 0%, 15%, or 20%, depending on the thresholds and filing status of the taxpayers. And as you can see, the short-term capital gains will still be at the ordinary 37%. So as Emily did mention, both countries do tax capital gains more favorably, but they do have a different approach. And from this chart here, you can see that both countries, for Canada, rates are generally higher than the US side, but this is not always the case. For a US person living in Canada, filing tax returns in both countries, Generally, it means that there is little to no U.S. tax liability on capital gains after considering foreign tax credits, which we're going to go over later in a bit. But there are certain circumstances here. For example, if there's significant short-term capital gains, then tax at ordinary rates, it could mean that the end result is that U.S. tax is higher than Canada. There's also certain high tax states that would result in higher tax rates for states plus federal compared to provincial plus Canadian rates. One other thing to consider that's not on the slide is that there's also a net investment income tax when calculating U.S. tax liability. Emily,
We'll,
do you have any questions on this?
we'll talk about that particular tax a little bit more, Cassie.
Yeah.
I do have a question. Now, we have it on the slide that some state tax rate could be 0%. Why is that the case? Do they have a graduate tax rate?
Right. So that's a great question. So some states actually don't have personal income tax at all. And some of these states are, for example, Alaska, Florida, Nevada. There's a couple other states as well that don't have income tax. Whereas the other end of the spectrum, as you can see, the 13.3%, that is the highest tax rate there is, and that's in California, where there is no special capital gains rates at all. So next, Emily is going to talk about sourcing for us.
Mm-hmm. Thank you, Cassie. But I guess what it also highlights is that while we don't want to live by tax result, where we end up living could make a difference.
Right,
Yeah.
exactly.
Thanks. Sourcing. Sourcing of a capital gain to a country is important since it determines which country has the first right to tax that income, and it ensures that you pay the correct amount of tax to the respective country. It could also impact your overall tax liability on the gain, although it doesn't always. It's not always true because foreign tax credit. So each country has its own domestic rules regarding source of income. Generally, the country where the taxpayer is a resident of has the first right to tax that income, and the other country will provide foreign tax credit to reduce its tax liability on that income. Canada, for example, tax mostly based on tax residency, while the U.S. tax based on both residency and citizenship. So all these would make a difference, depends on your individual circumstances. But if for a Canadian, for U.S. citizen living in Canada, he would be taxed on worldwide basis in both countries. If he sold marketable securities, Canada will get to tax first. There are always exceptions when it comes to tax rules. Also, in the cross-border setting, the tax treaty between the two countries often determines how the income is sourced. So in the case of real property, both Canada and the U.S. retain the right to tax gains from sale of a property that's located in that country. But there are nuances and specific rules when the gains realized by business, or if you sell your interest in a business, which is value mainly attributable to real property. So if you're in that situation, have a closer look and to ensure the sourcing and taxing right of the country is correct. We often have clients moving from one country to the other because all these sourcing and taxing right issues. It's really important to ensure that we know the residency status, residency start date, and the realization time of the income. In the case of Canada, because we have deemed disposition rules, Cassie will discuss that later in more detail. The movement of people could also impact former Canadian residents' tax liability in the U.S. Do you have anything to add or questions, Cassie?
Yeah, actually, you were talking about foreign tax credits between the two countries. Does that mean this fully eliminates double taxation?
It's generally effective, but as you mentioned, there's the net investment income tax in the US, which cannot be offset by foreign tax credit from Canada. So it's a 3.8% tax on investment income, as the name suggests, and it's imposed on investment income over a certain threshold. And that threshold, it depends on your filing status. That one is, I guess, in a way, is a double taxation. Also, if it is a real property in Canada and the person lives in the US and this person is subject to state taxation, some states do not allow foreign tax credit. We mentioned California being a special high tax state. California is one such a state that does not allow foreign tax credit. And also some states allow foreign tax credit, not as a credit, but in the form of a deduction, which is not as effective as the reducing state tax liability.
Right. Thank you so much. So this actually brings us to polling question number 1. So you should be seeing a pop-up on your screen and you just need to select the answer and click submit. So the question is, we have a taxpayer who is a US citizen living in Canada. The taxpayer sells Amazon shares from a UK brokerage. So in this scenario, which country gets the first right to tax? So we did briefly touch on this. So please select what you think the answer is. So the options here are A, it's the first right to tax is US. B, it will be Canada. C, the UK. And D, no idea. And that is totally fine if you have no clue. So just select an answer and click submit. We'll give a few seconds here. Perfect. I think polling is closed. And majority said Canada, 75%. So great work. The answer is the first country that gets the tax is Canada. So what happens is that because the taxpayer is living in Canada and generally public shares are taxed in the place of residence, then Canada gets first right to tax here. But since the person is a US citizen, they'll also need to report the sale on a US tax return and then take the Canadian final tax liability as a foreign tax credit to offset the US tax on that side. Okay. So next, Emily will actually give us an example of this to better explain the situation.
Thanks, Cassie. This question highlights how capital gains taxed more favorably compared to ordinary income. For simplicity, we are only using highest applicable tax rate and we're ignoring foreign exchange differences. So if you look at the grayed area on the middle section of the example, this is a tax on ordinary income, and it could be Canadian source employment income, business income, or interest income. Canada has the first tax rate because this person lives in BC, but he's a US citizen. Okay, and the US will grant foreign tax credit. So if we work through out of this $100 income, BC's the highest tax rate is about 54%, and the US federal rate is 37%. But the US will grant foreign tax credit, which is limited to the US rate on this income. So the net result really is a Canadian tax liability of 54%, and the net income is 47%. Now, in the gray, in the area beside the gray, this blue area, we have gain from sale of Apple shares, and then we know Apple is corporation, it's a U.S. corporation, but the gain is still sourced to Canada because this is where the taxpayer lives. Canada is his resident country. Canada still has the first right to tax that income, but because only 50% of the gain is taxable in Canada, the rate on the $100 gain is about 27%. U.S. federal rate on the long-term capital gain is 20%, but because it's sourced to Canada, the U.S. will grant foreign tax credit that fully offset the regular U.S. tax. It does not offset net at about 4%. So the combined Canadian US tax rate is about 31%. So as you can see, if you can realize income in the form of capital gain compared to ordinary income, it's taxed at significantly lower rates. I believe Cassie has the next slide on deemed disposition rules in Canada.
Great, thank you so much, Emily, for that example. So now we'll be talking about Canada's deemed disposition rules, and this is mainly a Canadian concept. So there's 4 different scenarios that we're going to cover here. So we'll start with the first one. This is about a taxpayer that moves to Canada. They're deemed to dispose of certain assets immediately before entry. So assets like marketable securities, private corporate shares, and certain real and personal use properties as well. This usually means that the cost basis is bumped up to fair market value on the date of entry. So in a similar manner, the same categories of assets would be deemed disposed immediately before departing Canada as well. And that brings us down to departure tax here. So Canada basically taxes on the accrued unrealized capital gains at the time of immigration, called departure tax. And this is basically Canada's last chance to tax on assets before the person leaves, because Canada does tax based on residency rather than citizenship. So there are certain exceptions to departure tax. Certain exceptions are Canadian taxable real property, cash counts, registered retirement savings plans, and a few others as well. So Canada taxes on this, but there is no such tax on the US side upon move. So in order to avoid double taxation issues where US will tax the same gain at a later date when sold, there is an election on the US side to increase the basis in the US to match the deemed disposed values. And the election will need to be filed during the year that deemed disposition happened on the US tax return. Okay, so the next point we're going to cover is the change in use of real property. So basically, Canada also deems real property as disposed when its use changes. So this is either a personal use real property being changed to an income producing property, such as a rental, or vice versa. So the principal residence exemption does still apply, and this subject Emily will touch on later in a later slide in this presentation. If, for example, the person used it as a principal residence at some point. And there are also certain other elections available as well to defer the gains on the deemed disposition here for change of use. We won't cover too much of this in this presentation, but do reach out after if you have questions, and we can gladly help for that. The last scenario we're going to look at is that we'll talk about the deemed dispositions on death. So a taxpayer is deemed to have disposed of all of their assets on death, and the gains are taxed on the final Canadian tax return. There are certain assets that are exempt here from the treatment and directly rolls over to the surviving spouse. Basically, this deemed disposition on death is a Canadian concept, and it's very different than US estate tax. So
Cassie,
yeah.
Can I ask you a question? Did I cut you off there? So
Oh, no.
sorry about that.
Yeah.
We get asked a lot by clients moving to Canada from abroad
Mhm.
that we say, oh, make sure that you establish fair market value of the asset you bring into
Right.
Canada.
Mhm.
How do you have any advice in terms of how do you establish fair market value for them?
Yeah, for sure. So there are certain different examples, and the treatment for each asset is a little bit different. But generally, for example, if it's public shares traded in a brokerage, you can just look up the fair market value on the date of the move, which is pretty straightforward if it's a public share. For real property, for example, you can use a property assessment value near the date that you moved. And this is generally for the entry into Canada. And these values are actually not reported on the Canadian return when you do move into Canada, unlike the US, where you do need to make an election to report every single new basis. But for Canada, it's not reported and it's not required to be reported until the asset's actually sold. And you just need to remember to use these values, the new basis from when you entered Canada. You just need to remember to retain all the documents so that you can provide it to your tax accountant at the time and use the correct values. I hope that
Mm.
answers the question, Emily.
Does. Thank you, Cassie. And I guess what I also want to add is that we say use property assessment, but that's on the presumption that you believe it is reasonable.
Right.
And whether you think it's not reasonable, in particular, if you feel that property assessment is lower than what your property is worth, and this is a real asset, a real property, of course,
Mhm.
get an appraisal. And
Right. Sure.
also some asset, I guess, it's a lot harder to tell in terms of its value if it's privately held corporation, in which case perhaps a valuation would be the best way to go.
Right.
Thanks,
Thank you so
Cassie.
much. So next, Emily is going to talk about sale of principal residence here.
Right. Now, there there are actually a lot of similarities in how Canada and the US defined a principal resident, but there are differences on their taxation of a gain. So if it's in Canada, if the taxpayer is always used this property as its principal resident, Canada provides a full principal resident exemption, and because of that, the gain's not taxed at all. And until actually very recently, Canada does not even take into account the ownership period. But since 2016, to claim the principal resident exemption, Canada now requires the taxpayer to designate the property sold as a principal resident. This is done on CRA Form 2091, and it needs to be filed with the return for the year of the sale. Late filing is actually subject to penalty. Now, when a Canadian resident moves to the US and sold his former Canadian principal resident within a year, he could still be eligible for a full exemption and partial exemption if it's sold at a later date. The Canada has a federal budget of 2022 that brought in what is called anti-flipping deeming rule. It's effective as of January 1st, 2023. So now we do care in Canada in terms of ownership period of a property. So if somebody sells a residential property located in Canada and the profit from the flipped property is treated as the business income, what is a flipped property? This is a property that's held for less than a year. So 365 days. So even if this person lived in the property and used it as his principal resident prior to the sale, he can't claim principal resident exemption, and he can't use the 50% capital gain inclusion rate. And also, if the sale result in a loss, the loss is denied. So this is Canada's one of the ways to improve affordability and ensure that people live their lives with principal resident as their home rather than an investment. There are exceptions to the deeming rules, mostly for live events like death, divorce, and certain relocations, and so on. So on the U.S. side, when the person sells principal resident, he can exempt up to $250,000. This is US dollars of gain. A couple co-owning the property and filing jointly can exclude twice as much, so $500,000 of US. Now, a surviving spouse can also be eligible for the higher threshold if the house is sold within 2 years of a decedent spouse's death. On the US side, the person actually is not required to be using the property as the principal resident at time of the sale. If he owned and used it for periods totaling 2 years or more in the last 5 years, period ending on the date of the sale. But because of this 2-year requirement, the exclusion can only be claimed once every 2 years. A partial inclusion may be available if this person has to sell without meeting the 2 years requirement. If the sale is resulted to as a result of change of employment location, serious health issues, or other unforeseeable circumstances. But these events must be the main reason for the sale. There are actually also exceptions from the 2-year requirement for temporary absences. We won't go into that too much, but if you have such a situation, do speak to a tax accountant. Is this time for our polling question number 2?
I believe it is.
Okay. Now you see a pop-up screen for the next question. And we just talked about this. So what are the exceptions to U.S. principal resident exclusion limitations? That's the 2-year use limitation. And the answers could be change in employment, health reasons, or other unforeseen circumstances, or could be all of the above. We'll give you a few more seconds to decide and submit. Okay. Well done. Vast majority of you selected all of the above. Excellent. So we're still staying on real property. Cassie will discuss them in more detail.
Thank you so much, Emily. So I'll start with talking about the sale of US real property by a non-US person. So there's such a thing called Foreign Investment in Real Property Tax Act. So that's called FIRPTA. And this applies to non-US persons when they sell a US real property. There is a US tax withholding requirement on non-US persons selling US real property, and usually it ranges between 0 to 15%. To get a 0% withholding rate, the gross proceeds need to be less than 300,000 US dollars. And there are certain other requirements that need to be met as well, such as using it as a residence. The 10% withholding would be allowed for proceeds between 300 to 1 million US dollars of gross proceeds, but there are also other requirements to be met. Usually, there's an automatic 15% withholding if none of the requirements are met. And this is for anything over 1 million US dollars in sale. So certain states also have withholding tax as well. And certain examples would be California, Hawaii, and several others too, when a real property in that state has been sold. So even though there is withholding tax, the federal and state tax returns need to still be filed. And on the tax return itself, the taxpayer will need to make sure to properly calculate the capital gain or loss, and also identifying it as long-term or short-term gains. As we talked about earlier, the long-term is being held over 1 year, whereas short-term is 1 year or less. There could also be a recapture of depreciation if the property was used as a rental or other investment property. And this basically states that any depreciation previously taken on the property needs to be added back as recapture. And this tax rate is actually at up to 25%. So if the seller is a Canadian person, Canadian resident, then they will also need to report the gain on their Canadian tax return, even though it's the sale of a U.S. real property. Since as a Canadian resident, you'll be required to report on worldwide income. So Canada will basically calculate the tax, but they do take the final U.S. tax liability and use it as a foreign tax credit to offset the gains. So next slide, I'll be talking about the other side. So what if there's a sale of Canadian real property by someone who is not resident in Canada? Well, where the U.S. has FIRTA, and that applies to non-U.S. persons, Canadian withholding tax is actually applying to non-residents, since Canada taxes on residency instead of citizenship. So the withholding tax here is 25% of gross proceeds, and this usually is the automatic tax rate. However, withholding tax can be reduced by filing for what's called a clearance certificate. This application will need to be filed within 10 days of the closing of the real property sale. And on this application, the taxpayer can report the cost of the property at which they purchased it at to reduce the withholding tax. And that means the withholding tax will be on the net gain, but this is still going to be before expenses, as expenses and improvements can't be reduced at this time. So next we have that principal residence exemption can also be available if it was previously a principal residence. But the total withholding tax requirement is still applicable until the taxpayer applies for a clearance certificate. So this means that there is you will have a tax withholding on a lot more than what you would actually be owing in the end. So this could be a tax cash flow issue, and therefore it could make sense to apply for this clearance certificate to get back some of the cash that's being withheld. And here we also want to briefly mention the underused housing tax, which is a relatively new concept that Canada implemented earlier this year. It does interact with the sale of real property here. For example, if the underused housing tax is required to be filed, but the taxpayer failed to file it, CRA may refuse to issue the clearance certificate, even if filed timely. So Emily will actually cover this at a later slide to just go into more detail. Finally, when selling Canadian real property, the taxpayer will need to file a Canadian tax return, even if they are not resident in Canada. So this is because it is a Canadian real property, so Canada does have the right to tax that. And on the tax return itself, the taxpayer can actually be able to claim any selling expenses and improvements on the property that was not allowed for the clearance certificate application. Okay. Emily, do you have any other comments on this slide?
Well, I was wondering that if a U.S. person living in the U.S. Sold a Canadian real property, and he prepares his U.S. return, do you have any advice for him on the U.S. side?
Right. That's a good question. So, for a US person, the sale of Canadian real property is actually still reportable on the Canadian tax return, kind of similar to in the previous slide where we mentioned that, even if selling a US real property and you're a Canadian person, it still needs to be reported. So it's a similar concept here. But basically, a taxpayer will need to make sure that they calculate the gains properly using the right basis, because the two countries may have a different basis for the real property. So the end resulting net capital gain could be different. Other things to watch out for would be foreign exchange differences or any depreciation that was taken on the property if there was an investment property. So basically, in a similar way, the capital gains here would be sourced to Canada, and the final tax liability paid or calculated on the Canadian tax return that was filed would be able to be taken as a foreign tax credit on the US tax return. So one thing to watch out for is that the total withholding tax cannot be taken as a foreign tax credit on the US return. But you have to use the final Canadian tax after filing the Canadian return. So the gain itself is sourced to Canada, and then the foreign tax credits would reduce US federal tax. But as Emily mentioned in a previous slide, certain states may not take the foreign tax credit and certain states may just have a deduction. So the results would be a little bit different here. Okay.
Yes, well, these are really good advice, Cassie. And one thing we do want to point out that unlike Canada's provinces, and you may have gathered, each US state have their own tax rules, and it's very important for Canadians purchasing US properties or moving to the US to have to look into specific tax rules of the state that may be applicable to them.
Yeah, that's for sure. So next slide, I believe we have our third polling question. Let's see, perfect. Polling question number 3. So you should see a pop-up here and make sure to select the answer and click submit. So the question here is, if FIRPTA is correctly withheld, which we previously talked about when it came to a US real property, is a US federal income tax return still required to be filed? So we have a few options here. Option A is that yes, the US federal tax return still needs to be filed. B is no. C, only file it to get a tax refund. Or D, only file it if there is additional tax owing. So just pick what you think is correct, and we'll look at the answer here in a few seconds. I think the poll is closed, and the answer for majority is yes, that's 76%. So great work on getting the right answer. So yes, the US tax return still needs to be filed, even if FIRPTA is withheld. So basically, it is a requirement to file the US tax return because it's a US real property that's being sold. And generally, it's very difficult, if not impossible, for FIRPTA to actually be the actual tax owing amount to be held, as it is just a percentage on the gross proceeds. Do you have any other comments, Emily?
No, I think a lot of times what we see is a client a Canadian person selling in the US, and they also should know that if this is the first time they're filing US tax returns, there are other implications. For example, they need to acquire a U.S. tax identification number. So
Mhm.
some planning is advised, but a lot of times CRS or similar to CRA, they could take months refunding this withholding amount. So the more prepared you are, and if to the extent possible, applying for tax identification numbers, sometimes that will speed up the process.
Right, for sure. Perfect, thank you very much. And next, Emily is going to talk a bit more about the underused housing tax, which I briefly mentioned earlier.
Thanks, Cassie. As Cassie indicated, this is a new law. And based on my discussions with my client, I feel that there's not enough awareness of this. Now, underused housing tax was announced as part of 2021 Canadian federal budget. It is aimed at non-residents of Canada who own residential properties located in Canada. And it's aimed to give them a motivation to make the property available to Canadians. It could, however, impact some Canadian persons. This tax is 1% of properties, the particular property's taxable value. Now, we should distinguish in terms of the filing obligation, which could capture a lot of people, versus people who are subject to actual tax liability.
Mhm.
This tax is effective as of January 1st, 2022. And so it is viable for the calendar year 2022. And I think the filing requirement was announced, I believe it's December 2022. And the due date would be May 1st, 2023, because the regular filing due date is April 30th. And because it was announced so late, people were not caught by surprise. And CRA has now allowed for 2022 form to be filed later on. So as long as it's filed and paid by October 31st, 2023, CRA will not impose failure to file penalties, which is not insignificant. The failure to file penalty for an individual is minimum $5,000 and $10,000 for corporation. It could be higher if you're actually subject to this tax. And also, if the form is filed after December 31st of the following year, your exemption could be denied to some extent. Okay. Well, let's have a closer look at this. And well, like a lot of new tax rules, there are a lot of new terminologies associated with one. There's a group of people called excluded people. These are the ones who do not need to file this form. The form number is UHT-2900. Okay. So who are the excluded persons? They are Canadian citizens or permanent residents who own this Canadian residential property. They own it personally and directly. Other people who are exempted are Canadian public corporations, charities, housing co-ops, indigenous governing bodies, and also certain real estate trusts. Okay. There's another group of people called affected owners, and these are generally the people who are not excluded persons. And interestingly enough, they include some Canadians. So these people are required to file the form, even if they're not subject to this tax, as they will require to file this form to claim exclusion. Okay. As I said, this group people would include Canadian citizens or permanent residents who own properties as a trustee of a trust or partner of a partnership. It also includes Canadian private corporations. Okay, and it definitely includes non-Canadian persons. And they would have to file to claim an exemption. Where an exemption is not available, the tax is it's payable. There's a whole list of exemptions, and they're generally based on type of owner, availability of the property, location and use of the property and type of occupants. But generally, to summarize, if you use this this property as a principal resident, or if you rent it long term to external tenant, or if this it's a vacation property in a certain eligible area, and you use it more than at least 28 days during the year, or it is newly constructed or purchased during the year, or the owner passed away during the year, there's also exemption for that, or if the property is rendered inhabitable. Now, going back to the vacation property, on the CRA website, there's actually a link that you could use to determine whether your property is in such an area. It's usually in a more rural setting and outside urban areas. So if you're wondering about that particular assumption, I encourage you to confirm. Okay. Now, given the penalty exposure, residential property owners really need to determine if they're subject to this tax, and if not, are they still be required to file this form to claim the exemption? But we've come across cases where it's actually not completely clear if they're excluded or affected owners. So sometimes care would need to be taken to come to that determination. And if there's any doubt, perhaps it makes sense to file, just to err on the side of caution.
Mhm. Okay. So Emily, I actually have a question for you.
Sure, Cassie.
You did mention, like, we all know that the underused housing tax is fairly new and something that a lot of taxpayers are not familiar with. Um,
Mhm.
how would they know if they actually need to file, though?
They need to go through until it determined how they own this property. And sometimes it's not quite clear, especially if there's a bare trustee situation, or if you have a co-owner, are you actually in a partnership and form together to carry on business for profit purposes? So you do have to examine your ownership structure more closely and feel comfortable that that if you're a Canadian citizen or permanent resident, that you don't own this property personally and directly, and you're excluded persons, or if you are in doubt that you could be affected owners. But if you are, have a closer look at all the available exemptions and find one or two that may be available to you. Does that answer your question, Cassie?
Yeah, it does. Just a quick note though, does CRA ever communicate with people that they need to file, or do they need to actually figure it out themselves?
Great question. As far as I know, CRA has not notified individual owners that they may be required to file this. This is a very new tax, and I think there are more guidance coming out, or we hope there will be additional guidance come out, and we'll have to see how it unfolds.
Perfect. Thank you so much.
Now we are moving across the border to discuss a new tax. In this case, is imposed by Washington, and is an excise tax rather than income tax. As we mentioned, some of the U.S. states do not impose income tax, and Washington is one of those. Okay, so this new tax is 7%, and it is on long-term capital gains on certain type of asset, and it is only impacting and imposed on individual taxpayers. It applies to sales after 2021, and it's only accessible on long-term capital gains above $250,000 a deduction, as this is the US dollars. Okay, there are some exceptions, including gains on real estate, sale of controlling interest in an entity that's in the real estate business, and asset held in a retirement savings plan. There are other exceptions, but these are probably the main ones that most people would rely on. Now, there are sourcing rules associated with this tax. For example, the gains from the sale of a tangible property are sourced to Washington if it is located in Washington, or if the taxpayer is a resident of the state at the time of the sale, or for intangible properties if the person is domiciled in Washington at that time. Now, the filing due date is the same as the individual's U.S. federal income tax return for the calendar year, and the payment due date is it's the same. That if you extend the federal income tax return, you could get a later due date, but the payment due date it cannot be extended. Okay, and there's penalties associated with failure to file and pay this tax. It's my opinion, at least, that this tax likely will not impact too many people, but it is still good to be aware, just in case that if you fall into this category, and ensure that you file and report accordingly. Well, I think this concludes our webinar. We want to thank you again for attending, and please complete our survey to help us improve. We will stay on until 10 o'clock to address some of the questions. Janice and Christian, do we have some questions?
We do. So our first question relates to trading of marketable securities, such as publicly traded stocks and bonds. So when would this type of trading activity result in business income rather than a capital gain?
Oh, well, that's a good question. That's not something we actually covered during our webinar, but it's definitely relevant. I mentioned our July 2022 webinar. If you missed that one, I would highly recommend you to watch that one, because that one actually discussed the factors that could determine whether the profit from a sale of marketable securities could potentially be considered business income. And these factors, not any one of them probably is definitive, but consider them in as a group could determine whether you're likely be treated as engaged in security business. So some of these factors would include, are you in the security business? Are you quite experienced in trading marketable securities? How often do you trade? Do you trade extensively or occasionally? How long do you hold these investment? Or do you actually offer and invite people to sell investment to you? And also, what type of investment do you engaged in? For most people, they probably would buy investments that are probably deemed safer and have dividend income. But for people who are in trading business, maybe that's a less a motivation. So yeah, these are all the factors that you would want to look at, and would be glad to help you if you in such a situation and need some assistance.
Thanks so much, Emily. So our next question comes from a Canadian resident who is selling real property. This property is a second home, but it's not held for rental use. And the question is, what deductions can be claimed to reduce their Canadian and U.S. tax on the sale of the property?
Cassie, do you want to take this one?
Sure, I'll take this one. So in general, improvements can be taken as a deduction for tax purposes. So basically, any significant improvements that are made on the real property should be recorded, summarized, and can be included on the tax return when filing. Certain selling expenses as well. So upon sale of the property, usually there's legal fees and other fees as well that can be taken as a deduction. So normally, you should definitely retain the documents when you have these expenses. And generally, the tax accountant preparing your tax returns would need the seller's statements, as well as the original purchase statements from when you bought the property. And there should also be a summary of all the improvements that you've made on the property as well to be able to fully use the deductions. Emily, do you have any other comments on this item that I might have missed?
I think these are really good comments, Cassie. And I actually recently have a client who's selling his house, and he's having difficulty relocating documents from purchase. So I highly recommend you, as you go through each one of these major transactions, to retain the document. In his case, he's trying to locate his lawyer, but it's possible his lawyer has retired because it's from quite a number of years ago. So hold on to your important document that would support your basis.
Right, exactly.
Do we have other questions, Christian?
Yes. So our next one is also related to real property.
Okay.
And the question is if we can make an election to change the use from principal residence to rental without actually renting out the property. And the goal here is to bump up the cost basis, but maintain the use of the property for this individual's parents to use personally.
Okay. Well, that's interesting scenario. I suggest that if this person is not a U.S. citizen or green card holder, this person may actually not have to make an election in Canada just to get a bump up basis for U.S. purposes. So under the treaty, this is Treaty Article 13, there's actually provision that if it's a Canadian resident moving to the U.S., because this principal resident would not be subject to deemed disposition because it's real property located in Canada, in order to preclude pre-residency capital gains from U.S. taxation, U.S. will actually allow its tax basis to be no less than the fair market value of the property at the time of the move. This is not available to a U.S. citizen, however.
Thanks, Emily. So our next question comes from somebody who holds a Canadian RRSP and they hold US securities inside the RRSP. What are the implications of selling those US securities?
Okay, I think I can take this one.
Okay.
We briefly mentioned the registered retirement savings plan, but we didn't go into too much detail. But basically, there would generally be no implications in Canada until distributions are received by the taxpayer. But in the case where it's a U.S. person, any distributions would be taxable on the U.S. tax return and Canadian return. So basically, the income would be sourced to Canada. And there's a possibility that the basis for the US side on these RSPs will be different. On the other hand, I just wanted to also touch on tax-free savings accounts because this is a Canadian concept and some US persons may have TFSAs. So in this case, there would be different US tax implications here, where if a US person has a TFSA and income is earned, it's taxable for a US person on the US return, even if there's no distribution. So there could be a problem with the two countries having a different result, because in Canada, any income from a TFSA is not taxable, but on the US side, it would be. So there are certain things in RSPs and TFSAs that US persons should be aware of. Emily, do you have anything else to add, or?
I think that's pretty comprehensive answer. Thanks, Cassie. We have about a minute to go. Can we take one more question, Cassie? What do you think?
Yeah, I think we can go for that.
Okay, let's have one more question, if we have one.
Okay. So one more comes from an individual who has multiple investment properties. What are the tax implications on selling those investment properties? This is a U.S. citizen who lives in BC.
Okay. Okay. Um, well, it's not completely clear if this person is in the real estate business or just bought a couple of properties and holding long term for gains and would not be considered to be engaged in the business. But if he is in the real estate business and develop and hold real properties for sale, he may have business income associated with his properties. The income would be subject to both U.S. federal and state income tax if these properties are located in the states. Did this person say if the properties are located in the U.S. or Canada?
It
Christian? Okay.
doesn't specify.
Okay. So if they are located in the U.S., it could be subject to U.S. taxation. Okay. And because this person's a Canadian resident, he will be subject to Canadian income as well. Now, if the properties are instead capital asset, then he'll likely get capital gain treatment. And again, he's subject to US and Canadian tax on worldwide basis. The country where the properties are located in would generally have the first right to tax, and the other country will grant foreign tax credit. Because he's a Canadian resident and US citizen, there should not be any Canadian or US, at least federal withholding requirement. Hope that's helpful. We are now 2 minutes past 10 o'clock. We want to thank everyone again for attending, and thank you, Janice and Christian, with your help with the questions. We want to wish everybody a wonderful day and hope to see you at our future webinars. Thank you so much.
Thank you.